Hey guys, welcome back to the Real Estate Monopoly. My name is Kerwin.
And my name is Kenneth.
And this is the Real Estate Monopoly. And today we are very excited to be here. Kenneth, how you doing?
I'm doing phenomenal, man. Almost halfway through the week, very
Yes.
busy, but
Name one stressor
blessed.
right now. Top stressor.
Capital raising.
Okay, cool.
I think that's a stressor for
Cool,
everyone nowadays.
Cool. Yes, absolutely. And also, of course, though, we're just very excited to have an amazing guest here today and kind of break up our routine and just have an amazing conversation. So, Yonah, please say hello to the audience.
Hello to the audience. Welcome to the podcast, guys. I'm so excited to be here with you guys. I was expecting with Jeff also, Jeffrey.
Yeah.
I guess sometimes you do it 2, 3.
Well, the thing is, it's kind of hard to fit 3 of us in the screen sometimes. So we upgrade our camera. No, yeah, honestly though, it can be challenged. But Yonah, I'm going to give your background because this is an amazing background. Yonah is the business director at Madison Specs, a national cost segregation leader, and he's assisted clients in saving hundreds of millions of dollars of taxes through cost segregation, which we're going to break down today. He also has a background in teaching and a passion in real estate and for helping others. And he's a real estate investor, and he's also the host of the top podcast, Weiss Advice, which is an awesome name for a podcast, and it's coincidentally rhymes. I'm just kidding. That's not a coincidence. Awesome. Well, thanks again for being here, Yonah. I'd love to just by starting off, can you walk us through how you got into real estate and give us a little bit of background leading up to real estate?
Sure. Yeah. As you mentioned there, I was a teacher for many years. That's really my background. Still is in a lot of ways, because I feel like a lot of what I do carries over into my current role. But at a certain point, I realized I just, wasn't making enough money to make ends meet. And I needed to find something else on top of the teaching, even though that was my passion. And I'd started a nonprofit for, many years ago while I was teaching, to help underprivileged people who had gone through, stressful life events like health crises, a death in the family, things like that. And, was dealing with a lot of families that had gone through trauma and trying to raise money to help them, to help defray costs and things like that. And I had something similar happen to me. And I was like, well, thank God it wasn't so big, but I'm like, well, I need to be prepared and prepare my family for such a thing, so I don't have to have them going out and asking for money or asking whatever it was. So that was a big turning point for me. It just kind of had that realization. And this was about like 7 years ago or so. And I just reached out to a bunch of friends and like, hey, what do you think I should, do? Something, a side hustle, something and a lot of people said real estate. And I was like, okay, I'm open to anything, kind of open to opportunities at that point. Read a couple of books, and one thing led to another. Just met some friends, met some guy, and he was like, hey, why don't you come work with me and do commercial mortgages, underwriting and stuff like that. Underwriting and originating. I was like, okay, sure. I don't know a thing about it. He taught me everything about commercial real estate. Pretty amazing. And I just apprenticed I sat in his office like 4 days a week for about 8-9 months and just learned a tremendous amount. And then did some fix and flips, got my real estate broker's license to just learn about residential real estate. And one thing led to the other, and opportunity after opportunity came my way until I met this company, Madison, that I'm currently working for, and been very happy since then. I mean, that's 5 years now working with them, and it's just been amazing. And through that, I've been able to invest in other deals as a limited partner, passively investing, and then also as a general partner, and kind of shifting my gears more into that direction as time goes on.
Yeah, and that's awesome. And we've heard so much about Madison Specs. I mean, I feel like they're synonymous with cost segregation and multifamily cost segregation, and Madison Specs is always coming up. So can you maybe provide some more context for anyone in the audience that isn't familiar with what Madison Specs does?
Sure. So SPECS is actually an acronym. It's a double entendre because it means like building plans, but also means it's an acronym for Specialized Property Engineering Cost Segregation. So cost segregation, we'll get into what that is. It's actually a branch of a larger commercial real estate company called Madison Commercial Real Estate Services, and most known for actually title. So Madison Title is the largest national commercial title agent in the country. And they have a bunch of companies under them. One of them is Madison 1031, the QI, and the Madison Specs, which came about, I'd say I think 17 years ago, when they had a need for this. And kind of one of the founders came from a background in accounting, public accounting, and ran the cost segregation at like a large national accounting company. Like said, Grant Thornton, I think, and KPMG, some of the huge, accounting firms. And so they just started it. Over the years, we've obviously grown. And up to this point, we're doing about 5,000 cost segregation studies a year. Not just multifamily, every single asset class it can be done for, from single family up to, office skyscrapers and everything in between. And yeah, it's just been incredible to be part of the growth. I think, me having appeared on 300 podcasts and done hundreds of webinars over the years, it's been amazing to see how the company has grown.
Yeah, that's awesome. And we've seen the growth as well. I mean, our group also uses Madison Specs for a lot of their cost segregation studies. But to kind of go in, if you had to describe someone that doesn't even know what cost segregation or even depreciation is, do you mind kind of explaining what that is to someone that might not even be aware that that's a possibility in real estate?
Absolutely. So very basically, cost segregation is a income tax deduction that you get by buying a commercial or residential property. So anything besides your personal residence, if it is an income producing or investment or business property, you're able to take this tax deduction, and it's based on the principle that of depreciation. So the name, not to be confused with the actual meaning of the word, and this is where a lot of people get thrown out. Like depreciation sounds like negative, like I don't want my property to go down in value. And I've actually had people say that to me. And what we need to understand is it's just a borrowed term. It's a name that the IRS gave to this tax deduction that literally allows you to write off the entire value of your property by buying it. And it's an incentive, obviously, to help people put their money, have less tax liability, reinvest. Real estate is obviously a great tool for that. And so that's what depreciation is. And cost segregation is really just an advanced form of that. So instead of taking a little bit each year for your depreciation deduction and spreading it over, a long period of time, 27 and a half or 39 years, these kind of arbitrary numbers that the government gave, cost segregation allows you to break down the property into its individual components. And some of those components actually depreciate faster. And so you're able to take bigger deductions in the earlier years of ownership. So very simply put, it's a tax deduction that allows you to have more cash flow by having more deductions in the earlier years.
Yeah. And I think you touched on like straight line depreciation and how that kind of contrasts with like cost segregation, which is what you guys do. Can you expand on the difference between those two? Because I think the people that have heard about depreciation are more familiar with the latter.
Yeah, so straight line depreciation is pretty simple, meaning you take your property, say you buy something for $1 million and you take off a certain amount for the land, which does not depreciate, and then you spread that out over a 27.5 year period. The cost segregation method is really just finding certain items through an engineering process of breaking down the building into its components. And it used to be called component depreciation, which makes a lot more sense and relatable than cost segregation. Like you have to explain that to people. No, we're not, this is a tax write-off. Here we're talking about, and what we do is certain components actually depreciate on a 5-year or 7 or 15-year schedule, which are faster than that straight line depreciation schedule. So it's really just a method of taking those deductions, identifying what they are, and then taking bigger lump sum. Like if you imagine like you have this pool of potential deductions and you can pull from that and kind of front load a certain, 20, 30% or so to the first year or to the first few years, it's a huge opportunity.
Yeah, no, absolutely. And to all of our listeners listening out there, this is why the wealthy and just us in general and anyone that invests in real estate, this is a huge benefit as to why people choose to invest in real estate, because they can use that, depreciation in general, but also cost segregation to offset their taxes. And it's a huge benefit for real estate investors.
And it's specifically for real estate professionals, which I do want to touch on, but
yeah, we're not a CPA, but yes.
No, but in general, because like I believe we might as well touch on it now then. Real estate professionals are the ones that really get to maximize the benefits when it comes to these. Can you maybe expand on, well, first, what a real estate professional is, and then what the benefits of it are when it comes to cost segregation studies?
Yeah, that's correct. And it's a really good point. A lot of people like to sugarcoat cost segregation. It's like, yeah, this is the best thing in the world for everyone. But you're absolutely right. A real estate professional is basically when you, on your tax return, you have to write what your occupation is. If you write real estate professional, that's actually a definition by the IRS that says that you spend more than 50% of your time materially participating in a real estate trade or business, which means that you don't have another full-time job and you are either a broker or you're doing management. You own your own properties and you're managing them, doing renovations, construction, basically anything that involves the management and running of a rental property business. And so you may only have one or two or a few properties. As long as you're spending enough time and you don't have another full-time job, you or your spouse, which is the amazing thing, only one of you needs this status, and you now have this special tax status in the eyes of the IRS. What does that mean and how does that apply? Like you said, they're the only ones that really get the most benefit from the deductions, from cost segregation, from depreciation. The reason why that is because income is treated differently. Your income from your real estate, your rental properties, is treated as what's called passive income, even though it may not be passive, but it's called passive income. It's on your Schedule E. And any income that is quote unquote active income, meaning on your Schedule C, if you have a W-2, you 1099, you have any other sources of income, that's all treated as active income and separate from your rental income. So those two different sources of income are treated separately and therefore are taxed at different rates sometimes. And the depreciation, which is a passive income, a passive deduction or a passive loss, is used solely to offset your passive income, that bucket of rental property, or if you have other sources of passive income like royalties or passive business interest, does not include stocks or anything like that. That's still considered active. But all of those passive activities can be treated with and use the depreciation. The kicker is with the real estate professional status, and you guys can look this up. It's sometimes listed as REPS, REPS, real estate professional status. And my good friend Brandon Hall, the real estate CPA, actually has a guide which breaks it down, an unbelievable resource, which just breaks down all the definitions, everything you ever needed to know about this status and how to get it and how to maintain it, because it is looked at on a year-by-year basis. That allows you to use those passive deductions are no longer just limited to your passive income bucket. It's actually then can be used against your active income as well. So a classic example is a real estate broker who owns some rental properties as well. And I always urge anyone who has a real estate broker's license, and that's your thing, you're a broker, you're an agent, you're a realtor, you automatically have the real estate professional status, but you also need to own rentals and materially participate in the management of them at least 500 hours a year. And then you can get these deductions. What does that mean? Let's say you make $1 million from your, rental. You're a great, top 1% agent. You're paying a lot of taxes on that, right?
Yeah.
Well, if you own a rental property or a couple and you could do cost segregation, you could potentially get, $1 million of depreciation. I had a guy, perfect example, bought a $5 million property. It was in California, actually. So I think it was like 20 units or something like that.
Yeah.
Like you can imagine, thinking about the cost per unit there. It's just
that's crazy.
It's crazy, but he bought it and, with little money down and was able to pull out, over 20% of the depreciation in the first year and get $1 million tax write-off, and literally went from the year before paying $300,000-$400,000 in income tax.
Yeah.
He was able to literally knock that down to zero. So, otherwise, if you're not a real estate professional and you're just making $1 million high W-2, well, those losses can only be used against any rental income you have. Your W-2 is still going to be taxed at a high rate.
Well, that's awesome. And I'd love to know, because you're also I'm sure I believe in your bio, you says you're an investor, but you also work on the cost seg. So you're technically like a real estate professional as well, but not really, I guess your role in your job doesn't require you to have assets. Can you maybe expand on how you're taking advantage of the real estate professional in your own life and finances?
So personally, I'm not yet. I would, it is a goal of mine at some point. Although what I am doing this year is something else which is related. And I'll get to that in a second with short-term rentals, because there's an ability there, even if without the real estate professional status. So being in the real estate industry does not necessarily make you a real estate professional. So if you're a mortgage broker, if you work for a cost segregation company, even though you're fully involved in real estate all day long, every day, the IRS still does not define you as a real estate professional. Actually, they have like a very finite list of activities, right? And it's like construction, right? Managing, operating, brokering. And so it doesn't matter that you're a mortgage broker and you're doing that all day long, or you're a cost expert or things like that. Even if you work for a real estate investment company, but you're an employee and you don't actually own shares or own at least 5% of the company or 5% in each property, you're also not a real estate professional, which kind of sucks, because you're like, well, I am, but no, not according to the IRS. Yeah. And so they have weird definitions. That's how it works. So for me personally, I am working towards that eventually to do that. But one thing I am working on actively is what's called it's going around. I don't know if you come across this, the short-term rental loophole. You guys come across that one yet?
No, I've heard of it, but I haven't actually dived into it. So please enlighten us.
Yeah. So it's really cool. I mean, they call it a loophole. It's not, it's really just a rule in the passive activity rules that a lot of accountants don't even know about. And it was kind of become more popular lately just because there's been so much activity in the Airbnb, the short-term rental space over the past few years. I think it's gotten more attention. And what it says is that if you own a short-term rental and you are self-managing, which is really important, because if you have a manager, property manager, this does not apply. But if you are self-managing and the average stay is less than 7 days, the IRS treats it as a transient property, in which case it's more like a business with regards to depreciation. And it says that you can now use your losses, the deductions, depreciation from that property to offset your active income, because this property is treated like an active income, even though, and it is confusing, a lot of accountants get this wrong, because it's still in your Schedule E, which is your rental, listing your rental properties, but it's treated with the passive activity rules, treat it separately. So I'm not going to get into too, gory details here, but simply put, even without the real estate professional status, if you have a W-2, you have any job whatsoever, and you own even one short-term rental, the rules are so 100 hours a year of material participation, which basically, if you're setting up, if you're buying, if you're dealing with, and vendors, that's really, 100 hours a year plus more than anyone else. And you get that, which means I know a ton of people who aren't real estate professionals and are still doing cost segregation on their short-term rental properties and using the same advantage, the same activity.
I love that. And short-term rentals is really hot right now. So I think that's very applicable, really relevant, and like timely for our audience, because I'm sure people in the audience are going to be either interested in pursuing short-term rentals. I know a guy that I just met not that long ago, and he was actually pursuing that as well, because he's just getting into the industry. So it seems like wholesaling was popping back then. Now it's short-term rentals, and soon, hopefully, it'll be apartments again, because I think it's like a cycle.
But just kind of touching back, that's pretty great insight, and we are appreciative of you sharing that. But just kind of going back to, doing the studies itself, you mentioned engineers going out and kind of taking a look at the property and, just assessing what can be depreciated or what technically depreciates faster. What kind of things are they looking for, like when they go out, and what kind of like time frame is someone looking at when they do go out?
Sure, absolutely. And as we mentioned before, it's an engineering kind of breaking down of the property. So we do have engineers, and we have like 16, 17, I lost count how many on staff currently. And what they'll do is they'll either travel to the property, or actually when COVID hit, we started transitioning to do a lot of them virtually. Some types of properties, not all, but that we can just have a video call with our engineer. And what they're looking for is they're looking to break down the structure, right? You have things that are the walls, doors, windows, floor, foundation, right? Infrastructure things. The value of those components are 27 and a half year. That's the longer depreciation schedule. But the things that break out and are faster on a 5-year schedule is essentially anything non-structural in the eyes of the IRS. And that can still be attached. So think about like appliances or furniture or equipment. You can move them around. That's clearly what's called personal property or movable tangible property. All that depreciates on a 5-year schedule. But even things that are non-structural that are attached, like the flooring, if it's vinyl or carpeting, that's considered 5-year property. Whereas if you have tile flooring, that's considered attached permanently and is considered structural. So there are certain nuances to that, which will make a difference on how much of the value you can actually depreciate faster. Other things include fixtures or even millwork or window treatments, shelving, cabinets, countertops, things like that. All of those things will depreciate faster. So when we're looking at a an apartment building, for example, of multifamily, it adds up. You're looking in each unit, and it can be sometimes 20 or 25% of the value of the property that can go into these faster depreciation assets.
In terms of doing and actually conducting a cost segregation study, I'm sure some investors are going to be wondering, like, is it even worth them even doing it? What kind of properties maybe, and this is leading into my question, what type of property would it be more beneficial to have a cost segregation study, and when might it not even be worth it? And I believe if you want to expand on like the smaller property versus the larger property, but also different asset classes.
Sure. It's a really good question because it depends. I mean, it really does. There are so many different aspects, types of properties, but I have some general rule of thumbs. And one thing, once we cover those rule of thumbs, it's important to realize that most companies, and Madison Specs including, will provide an upfront free analysis of any property to show you what the potential tax savings are. So you can know ahead of time what you're looking at. So I'm going to tell you some general rule of thumbs, but if you have an individual case, you're like, hey, I really wonder, I'm about to buy this property, or I did buy this property, whatever. I wonder how much it would make a difference. Well, just reach out and you can know, right? It's not a secret, but there are some general rule of thumb. So I think any property whatsoever over $500,000 purchase price is usually a no-brainer. There are certain types of properties that even a smaller amount, lower amount can be beneficial. Like I mentioned, the Airbnb properties, there's a ton of fixtures and amenities and appliances and furnishings and things like that. So the percentage of the cost segregation will actually be higher than another type of property, like another type of single family long-term rental, where you may not own the furniture and appliances, for example. Warehouses are like on the low end of the spectrum. So if you can imagine, there's pretty much not much there. Maybe you have some shelving, maybe you have some security systems and things like that that are going to be 5-year. Everything else is going to be structural, except for you may have landscaping and land improvements that we didn't mention before, but those are 15-year. Those actually are depreciated faster as well. So you can have benefit there. On the high end of the spectrum are, and so again, warehouses may be like about 10% that you can depreciate of the property in faster depreciation. Whereas on the high end, you have things like mobile home parks or RV parks, which again, also are things that have become a little more popular recently, or golf courses. All those, what they have in common is the majority of what you're buying is actually the land improvements. So land doesn't depreciate. So that you're not going to be able to depreciate, but what's on top of the land, that's what's important, can. So if you buy a mobile home park, for example, you don't even own any of the homes. The tenants may own all their homes. You just own like maybe a clubhouse. And what's really important is all the concrete, right? You have concrete slabs under each home, or pavement, driveways, the streets in that park, and the landscaping and fencing and all those things actually are considered 15-year depreciation assets. And why that's important is that you can take it all up front in the first year with something called 100% bonus depreciation. And so mobile home parks can be literally between 50 to 80% of your purchase price you can literally get as a first year tax write-off. So that's huge. And then in the middle, you'll have things like multifamily, self-storage, office, retail, generally, kind of fluctuate between, 20 to 30% of the tax base is the amount you can depreciate of the property to a faster scale.
Yeah. And that's a big portion of, that's a great breakdown as to what, different asset class can provide. But my question was from earlier. So I'm sure you work with a lot of different investors, different asset classes, but I'm sure a good portion of investors, especially in multifamily space, are value add investors. So these investors, we're obviously, we're also value add investors, but we're also going in with a business plan to renovate and spend, $1, $2, maybe more $1 million on improving the property itself. So with those kind of investors, do you typically advise them to do a cost segregation study beforehand and then after the improvements? And is that what they typically do, or what kind of advice would you give them?
So it really does depend, because there are certain scenarios where the advice would change. But I'm really glad you brought this up, because it is something that is very, very common, right? If you buy a property, when we're doing a cost segregation, we're looking at the purchase price and we're looking at the property as is and basically breaking down that depreciation so you can take those deductions. And the depreciation, the amount you can actually depreciate, is solely based on the purchase price. So even if it goes up in value, the depreciation amount doesn't change. If you get it appraised at a higher value, the depreciation amount never changes. The only time it does change is when you actually do a value add. Well, you add more money into the property. And so if the property is rented out, right, after you purchase it, and especially if the value add and the capital improvements are done in the following year, right? Even if it's done in the same year, but as long as it's rented out first, you're able to capture on both, meaning you're able to take the cost segregation on the acquisition, and then whatever money is spent on the improvements, you can depreciate that as well, or you should depreciate all that money. And you can do a separate cost segregation study just on that money spent. So we can break down that. And oftentimes it's going to be a much higher percentage is going towards those depreciation, because often you're not doing major structural improvements, maybe doing some, but generally speaking, maybe putting in new kitchens, putting in new flooring, new cabinets, things like that. All of those things are typically faster, right? The 5-year personal property, faster depreciation things. And so it can be done on a yearly basis, but usually what people will do is they'll do that follow-up renovations study either in the following year or once the full renovations have been completed. And again, there are certain scenarios where it's not possible to do both. You may only be able to do one or the other. And a great example is if you buy a vacant property and it's not rented out, and you gut it and you do all the renovations. Unfortunately, in that case, you cannot do a cost segregation on the purchase. So you kind of miss out on the whole, a huge amount of the purchase price. Yeah. You're missing out a huge amount there. Yeah.
Yeah. And just to touch on that, I mean, that makes perfectly good sense. You can kind of get back somewhat of the money that you're spending on the property, which is great. But at the moment, we're all experiencing some really crazy times, with lenders, less leverage, and that kind of impacts us, of course, as buyers and buying properties, and of course sellers as selling properties. But from my experience or what I've been seeing lately, it also affects depreciation and what people are getting on cost segregation up front and things like that. So what have you been seeing, I guess, as of recently, and how can we, I guess, improve or get more money potentially up front as a cost seg?
Absolutely. The main thing that is going, and I mentioned that it is your depreciation amount that you can take from is totally based on your purchase price. Okay. However, it doesn't matter who's spending that money, meaning if it's the investors or equity or down payment, cash, whatever it is, or if it's the bank financing it. And so if you buy, let's just quick example, buy $1 million property and you're putting 20% down payment, right, and get 80% leverage, right? That's great. And it used to be something people were doing all the time. I think maybe, people are more conservative at this point and getting lower leverage. But if you do that, then you will get, to take depreciation based on that $1 million, not based on the $200,000 you put down. And therefore, the amount of depreciation you'll get back in the first year with bonus depreciation is going to be a lot higher, because proportionate to the amount of cash invested, that depreciation is higher. So if you get 20% of your property, right, you're getting a $200,000 bonus depreciation deduction in the first year, and you only put down $200,000. That totally is 100% of your investment back as a tax deduction. Now, take that same scenario, and let's say that you bought it with only 50% leverage, right? And which is very common. A lot of people are raising extra equity for, capital improvements, or raising extra equity for extra reserves and things like that, where they may not have done that in previous times. Well, that amount of equity going in is going to drastically affect the amount of total depreciation you can get per the investment. And so without getting too complicated in numbers here, it diminishes the amount of depreciation that you can get the more equity you are raising compared to the amount of financing and the bank is putting in.
Yeah, that's awesome. I love that you kind of broke it down, especially right now, because like Kenneth said, we have seen some changes, and I think things are always changing, and especially because I believe the previous administration had like certain cost seg benefits and depreciation benefits that I believe are changing. And so I did want to get that update from you. Do you have anything else to add about like where we are today in terms of the cost seg, and maybe where you see it going forward?
Yeah, and because like my brother mentioned, because it is supposed to be phasing out. I believe after this year is going to be the last year where you can get 100%, and then it'll be phased out over the next few years or so.
Exactly. So there was this what's called bonus depreciation. We touched on it briefly, which allows you to take 100% of those accelerated depreciation deductions in the first year. That came about through the Tax Cuts and Jobs Act back in 2017 and is set to start phasing out next year. So 2022 is the last year that you can take 100% of those deductions. In the first year, you can still do cost segregation. That's not going away. I can't say never because you never know never say never.
Yeah.
But the 2023 will go down to 80% bonus. Meaning you can take 80% of those accelerated deductions in the first year. The remaining 20% you can still spread over the cost segregation 15-year schedule. So that's the main change that is happening with regards to cost seg.
Awesome. Thank you so much for sharing that. And it is time for our speed round. Yonah, are you ready?
Oh, wow. Time flies.
Yes. Awesome.
I'm ready.
Let's get into it. So, first, I wanted to ask, has there been one thing that you're doing differently today that you weren't doing when you first started in real estate? Or maybe if you've worked with clients, something that a lot of times like you see the newer people not doing that the more experienced investors are. Either way, either approach you want to take.
Yeah, I think many things I'm doing differently now, but one thing that comes to mind is I have an assistant. Actually, I have 2 assistants now. So that's a huge benefit. Meaning it used to be so much back and forth, so much time being spent in emails and communication, things like that. And a lot of that has been streamlined more. So getting an assistant, a virtual assistant or not, doesn't matter. Just having someone else on your team to help you. Yeah.
Yeah, that's a great tip. And that's probably something we should look into.
We're hiring. It's our first hire.
Awesome. So for the second question, in business, what has been your biggest failure and how did you overcome it?
Or learning lesson.
Yeah. We like to call them lessons.
Yeah, they are definitely lessons. They're definitely learning lessons. I don't believe in failures. I think everything FAIL is the acronym, right? First attempt in learning. Yeah, I'm sure you guys have seen that before.
Yeah. Love that.
You know, it's a good meme right there.
Yes.
There
I'm gonna hashtag that.
Oh, there you go. Got for your thumbnail. Okay. But
I'm going to use that actually.
So failure, a big one for me, and this happened really early on, kind of in sales and in the cost seg, was that, and this happens to so many of us all the time. We have this kind of like shiny object syndrome, right?
Yeah.
Where we're thinking like, oh, this huge deal. It's like the best deal, and this happened to me once when I was doing a mortgage brokering. I also had like this huge, like, $300 million deal. And it was like, you put so much thought into it and time into it and everything like that. And so the biggest failure for me was something similar where I had someone who just requested 26 cost segregation studies on all shopping malls. It was like this huge project, right? So it was going to be a big deal for our company. It was going to be a big deal for everyone involved. But right at the beginning, the guy requested a discount. And to me, when someone does that nowadays, it kind of triggers a little bit of a red flag. Not always, because listen, everyone, and there's certain different cultures also, which I totally respect. I know there's certain cultures where you have to you can't not request a discount. It's just part of your culture.
Yeah.
So I respect that. I understand that. But this guy just kind of seemed a little bit shady and was like, oh, that's way too much. Let's get it for half the amount. I was like, what? You don't understand the value, millions, tens of millions of dollars in tax savings. And you're worried about a $5,000 fee. To me, that was a red flag. It turned out this guy ended up being the worst client ever. And so that was a big lesson for me. It's don't think about the big deal and the huge sale or the huge commission or whatever it is that's going to be in your mind. This is going to be huge. Look at the facts, humble yourself, ask advice from someone else who may be more experienced than you, and kind of get over that. So that was a big lesson for me.
It also sounds like your gut was maybe telling you something. And so also trusting your gut and your instincts.
Follow your gut, 100%.
I love it. I love it. Awesome. Well, if you had one book or that's how impacted you in terms of your personal life or business or both, what would that book be?
So personal life, I'll share one. I mean, The 7 Habits of Highly Effective People is one of my top books for, business and personal. It's just been incredible. So I'll just leave it with that. That's
Awesome.
that's a good one.
Awesome. And then the following question, what is your long-term goals for your business? And if you'd like to share personal goals, you can do that as well.
I want to be able to streamline a lot more of the process where I'm, able to free up as much time as possible, bring on more assistants, more people in the back office, and we have an incredible company. I mean, it's like 60 people. It's a huge company.
Mhm.
And they're doing great, streamline a lot of processes. I just want to continue doing that. So that's kind of my goal, to be able to take off a lot more time than I am, even though I don't really work. I kind of play on social media and do podcasts all day. So that's not
Yeah.
really like work, but that's for me a big goal.
That's awesome. I love it. And you shared a ton of wisdom today. If there was one piece of advice that you'd want our audience to walk away with from today's episode, what would that be?
I think it's probably something that you guys share often, but is that just learn, like continue your education. Power, right, is in the knowledge. When you just listen to podcasts like this, and you're never too young, right? You're never too old. You're never too anything to ask questions and to learn and educate yourself. There's so many, like cost segregation, like what is that? I'm sure people listening to this, if you're still listening to the end, right, and you've enjoyed this, and you were one of those people that at the beginning was like, what in the world is cost segregation? I have no idea. Well, guess what? There are probably dozens of other things like that can save you or help you, a huge amount, but you just have to, you don't know what you don't know.
Yeah, I agree. And I think people just have to remain curious. Like that's one of the traits that I think is a big indicator of how successful you'll be. And a lot of people lose it. So it's kind of sad, but stay curious, guys.
Yeah.
Awesome. Well, thanks so much, Yonah. It was a pleasure chatting with you. If anyone in our audience wants to learn more about you or just follow you on your journey, where can they go to find out more?
Well, you can always find me on LinkedIn. That's actually where I'm most active. I'm on all the socials, but LinkedIn is where I'm most active. Definitely send me a connection request with a little note saying that you listened to me on this podcast, or you can go to YonahWeiss.com.
Awesome. Thanks so much for your time, Yonah. And thanks everyone for tuning in today to the Real Estate Monopoly. Kenny, where can they drop a 5-star review?
Yes, you can find us on Apple,
Spotify,
pretty much everywhere that you can listen to podcasts. So wherever you're listening, your preferred listening place, drop us a 5-star review, comment, ask questions, and we'll make sure we answer them.
And guys, let's get out there and take action. Hope you guys have a great rest of your day.
Yes. Have a great one.